Hey everyone, welcome to Unit 14, International Transactions. In this topic we'll be talking about how do you actually tax when it relates to something international. For example, it could be a foreign resident, you could have earned income overseas and you're an Australian resident, or even what's the situation when you're a non-resident and you're dealing with foreign sourced income. So we'll deal with all of those situations. So this chapter is split up into 4 different topics here. So number 1 is taxation of foreign income. So that's basically when you're in Australia and you've got income overseas, how do we tax that? What are the exemptions? What are the offsets? What are the deductions? What are the regimes in place? Now the second topic is taxation of foreign residents. And that's basically when income is earned in Australia by people who are tax residents overseas. For example, a Hong Kong resident who earns shares in the Australian stock market. Third topic is taxation treaties. So a lot of countries, especially first world countries, have taxation agreements between them because it is quite a common occurrence that people have income going across multiple international jurisdictions. So there's a lot of rules in place in terms of how do you actually account for that. And then finally, anti-avoidance integrity measures, which we've actually got on the next page. And that's basically, on the next tab. So that's basically dealing with, there's a lot of rules in place by the government to stop situations where companies and individuals, they will minimize their tax by implementing, transfer pricing or other methodologies to basically transfer their tax obligation out of a high taxing country into a low taxing country. For example, they might earn $1 million in Australia, which has, a 30% roughly corporate tax rate, depending on what entity you're in. Now, you might go to some place like the Cayman Islands or Ireland, which are very low tax, sub 10%, some as low as 0% in some instances. So what they might do is they might set up an entity in those countries, those low tax areas. They might charge a management fee. So, they might charge $1 million management fee to the Australian entity. So even though it's got $1 million profit in Australia, it's got $1 million expenses as well, whereas the management entity in the Cayman Islands or wherever it is will record $1 million profit and they'll pay tax in that jurisdiction. So there's a number of rules put in place, not just in Australia but in many jurisdictions to prevent that, including transfer pricing rules, thin capitalization rules, which is around how much in interest debt deductions you can claim, as well as controlled foreign company CFC rules and transfer of trust rules, which we'll talk about later. So let's talk about the first chapter here, which is the taxation of foreign income. Again, this is when you are an Australian resident, and what's the situation when an Australian resident has income in a jurisdiction other than Australia. So the first rule is Australian residents will be liable for income tax on their worldwide income if they are Australian resident. And that's under section 6-5. Now, if you're a foreign resident, you're only taxed on your Australian-sourced income. But if you're an Australian resident, you're taxed on your whole worldwide income. Now, we'll touch on this a little bit later, but depending on whether you pay tax in another jurisdiction, they might actually apply tax first. For example, in the US, you might earn a dividend in the United States, and the United States government might actually withhold some tax and say that's your tax rate. So basically what happens later on, and we'll get to this soon, is in Australia is you'll actually get a credit for that. So you'll include it in your tax return regardless. You'll calculate your tax rate, say 30% or whatever it is, and then you'll calculate your tax payable, and then you'll actually get your offset against any tax that you already paid overseas, provided there is a double tax agreement with that country. Okay, so the first rule is the gross foreign income amount is included as assessable income, i.e. pre-withholding tax. We'll get to this in a second, but basically, so the first step is to record your gross income pre-withholding tax. So for example, you earn a dividend income in the United States, you're going to record your dividend income. Let's say the United States government withholds $1,000 in withholding tax. The first step is just to include the dividend amount, okay? We talk about this later about the foreign tax offset. So if you are entitled to a foreign income tax offset, And that would only be, so it's not just the fact that you've paid tax, you must be entitled to a foreign income tax offset. So it depends on what the country you're in, because some country might not actually have a double tax agreement with Australia or New Zealand, and therefore you wouldn't actually be able to claim the FITO. But if you are eligible to claim that, then you have to gross up for any foreign tax paid. So in the situation where you've got a dividend in the United States, the first step would be to include just the dividend income, and then if they withhold income tax, you also include that as part of your income. So consider it kind of like a franked dividend. You know how you would include the dividend in your income, you'd also include the franking credit as your income, so you gross that up. But then later on, after you calculate your tax payable, you then take that franking credit and also get an offset it against your tax. So similar thing with withholding tax, you increase your assessable amount and then you get the tax credit later on. And of course, exempt and non-assessable, not exempt income, non-A income is not to be included. Even for foreign income, it's the same. So same rules around deductibility of expenses. It's just that standard section 6-5 for income and section 8-1 for deductions. As long as the deduction or the expense was used for the purpose of gaining or producing assessable income, it is deductible, unless of course it's non-A income, and then you wouldn't get the deduction. Okay, so we talked about tax offsets, how you might be entitled to any withholding tax, and how you must gross up your income for any foreign tax paid. Okay, so here's when it starts to get tricky, and this is probably one of the more confusing chapters in all of the tax module, is talking about all of the different types of situations in a foreign tax environment and the different implications of each. So first of all, let's just get an understanding as to what each of these definitions mean. So the first one, a foreign subsidiary controlled foreign company, a CFC. So you'll see those initials coming up a few times in the international tax chapters. So a CFC is an offshore company controlled by the taxpayer. So certain foreign income may be taxed in Australia before it's actually received. So for example, I'm an Australian resident and I set up a company in Singapore. That will be a CFC because it's a foreign company, but it's controlled by an Australian taxpayer. Alright, next subcategory is foreign investment greater than 10% interest. So this is an offshore company in which the taxpayer, for the operation of a foreign equity distribution exemption, holds a participation interest in the foreign company greater than 10%. For operation of other rules, holds a non-portfolio interest, i.e. the taxpayer holds a voting interest in the foreign company greater than 10%. Detailed about this later on in the chapter, in case you're not sure what this means. Next one is basically the same thing, but with less than 10% interest. So foreign investment, less than 10% interest. So portfolio interest is an offshore company in which the taxpayer holds a participation interest in the foreign company of less than 10%. So it's either your investment in a foreign company is either non-portfolio interest or a portfolio interest. So portfolio interest is when you own less than 10%. Non-portfolio interest is when you own greater than 10%. So again, we'll talk about these a little bit later on. All of these are going to have different tax implications for foreign tax. So the next one is foreign branch, PE, i.e. a permanent establishment. So this is basically, a foreign branch is not a separate legal entity. So it's basically if I, as an individual or a company, were to go over to Singapore or another country and I don't set up a new company, I just continue to operate as I am, no separate legal entity. That would just be called a foreign branch, and it's called that because it's the same entity but branching out over there. It's a branch. So there's no separate legal entity. So it arises when a company carries out business activity at a separate location without the use of another entity. So income paid by a branch, the taxpayer retains its character because branch profits part of overall profits of the taxpayer, i.e. international transaction. And then finally, just a foreign rental property asset. So it's basically the taxpayer just holds a property in a foreign country from which it earns rental income and doesn't carry on a business. And the taxpayer does not have a branch. The type of offshore investment influences the type of foreign income received, e.g. a foreign subsidiary can repatriate profits as dividend income, a foreign branch cannot, as it's not a separate legal entity. And of course, the different types of foreign income do have significant implications, which we'll talk about later on, because depending on the type of income, it'll have a different type of withholding rate or a different tax rate and so forth, depending on the country you're in and the double tax agreement in place. For example, your dividend withholding tax rate might be different to your interest or your royalties withholding tax rate, and there might be different rules for royalties and so forth. So it's important to get that characterization correct. Okay, so now let's talk about where the investment is located and the impact of that. So I kind of touched on it before, because what this is going to be talking about is some countries have favorable tax rates, like high tax rates, and they've got great tax systems, so lots of double tax agreements and no shady laws where people can go to avoid tax. So these are the listed countries. These are the good countries, basically. So you're Australia, Canada, France, Germany, Japan, New Zealand, UK, US. They're conducive to business. They've got comprehensive tax systems. And generally, when you make an investment in these countries, it's for genuine business and commercial reasons. Now, on the other side is an unlisted country. Now, these are the types of countries like the Cayman Islands. I think Fiji is even on there. A bunch of other countries which are known, Luxembourg, I think, which are known for low tax jurisdiction, not particularly comprehensive tax systems, commonly used for tax avoidance. And if there's different implications depending on which type of country you're in. And when you lodge your tax return, whenever you record foreign income, you have to actually report whether the country you receive the income from is a listed country or an unlisted country. So regimes to avoid double taxation. So we mentioned this before. When you have income in another country, you're most likely going to get taxed in that country. Just like if you're a foreign resident in Australia, you're assessable on any Australian-sourced income. So going back to the US dividend example, I most likely, if I have dividends sourced in the US, most likely will have some sort of withholding tax or tax payable on those dividends. So what will happen is I'm then going to report that income in Australia as well, because I'm an Australian resident. I'm assessed on all my worldwide income. So what happens in principle is there's a double taxation. I'm going to get taxed in the United States, and then again I'm going to get taxed in Australia. So aside from withholding tax, which is the number one way to kind of cover that, if there is a double tax agreement between the two countries, there are certain foreign income exemptions, which actually mean that the income is exempt. You don't need to include it in your tax return, but it also means you can't claim any deductions against it because of Section 8-1. So these exemptions are for the purposes of preventing double taxation occurring in Australia. And these can be quite difficult to understand, but it's important to understand because we do get a lot of exam questions on them. So the first one is foreign branch income and capital gains exemption. Why is this exempt? It's because there's a foreign branch. It means there's no separate entity. So it's like myself paying myself a dividend. There's no separate legal entity. It would be double taxed. That's Section 23AH of the Income Tax Act 1936. Remember, if it's Income Tax Act 1936, you should list the actual act name as well, as opposed in your response, as opposed to Income Tax Act 1997, which is assumed by default that if you just say Section 768-5, people or the market will assume you're referring to Income Tax Act 1997. So when we reference to Section 23AH Income Tax Act 36, we should say the actual Income Tax Act 36 as well in our response. Okay, so moving on to the next foreign income exemption. The next one is foreign equity distribution example. For example, dividends received by an Australian company if the Australian shareholding in the foreign company is greater than 10%. Only applicable to companies. It wouldn't be the case if I was an individual investor in Australia receiving a dividend. This doesn't apply. What would happen in that situation would be the withholding tax situation we talked about before, where you'd have to, any withholding tax paid in the United States, provided there's a double tax agreement, US withhold that amount. That will go to tax paid. I would then include that dividend in my own personal Australian tax return as I'm an Australian resident, assessable on worldwide income. I would then gross up that by any withholding tax, so I'd increase my assessable income. I'd calculate my tax on my tax rate, and then I would offset my tax by a withholding offset amount. That's basically how you do it if you're an individual. But if you're a company and you receive dividends, if you receive dividends from a US company to an Australian company, and the Australian shareholding in the foreign company is greater than 10%, this distribution is actually exempt. It's non-assessable, non-exempt income. Okay, so moving on to the next exemption is previously attributed CFC income. Now, I've highlighted this one because this one is, a lot of people have trouble understanding what this actually means. It would also non-assessable, non-exempt income under Section 23 AI. This later on, we'll get to it in a second, so I won't spend too long going through it because we're going to go through each of these in detail. So there's the foreign equity distribution example and the foreign branch income. So we'll get to that in a second as to what it means, but remember, CFC, controlled foreign company. Okay, moving on, CTT Participation Exemption. So this is basically when you dispose of a foreign active asset, it makes it an exempt income under Section 768-505. And then finally, Conduit foreign income CFA exemption. So if you're reading through these and going, what do these mean? I only understand one or two of them. That's okay. We're going to go through it in more detail very, very soon. Okay, so now we're talking about some of the concepts we already mentioned before. So double taxation treaties. That's basically where you have a reciprocal agreement between two countries in respect of taxing rights. And this usually just outlines who is entitled to what income, tiebreaker rules, so basically when they're both at loggerheads, who wins in that scenario, and so forth. Okay, so now we're going to go into, in detail, each of the different exemptions and what they mean exactly. So the first one is the foreign branch income and capital gains exemption, so we talked about that earlier on. This is under Section 23AH of the Income Tax Act 1936. Exempts a few things, including capital gains derived by a company on the disposal of assets, but only if they were used in solely in carrying on the business and were not tainted assets. We'll talk about that later. It also exempts foreign income, capital gains, which we talked about, and capital losses. So this only applies to a foreign branch, not a subsidiary company. So as we mentioned before, permanent establishment equals branch. It means no separate entity. If you have a company set up, there's a separate entity, which means this exemption doesn't apply. So you'll see in the question something like they've set up operations, but they haven't set up a new entity or something like that. That would be a foreign branch. It's also applicable if there is interposed partnership between the Oz company and the foreign permanent establishment. So when you see PE, that's another word for branch, or permanent establishment equals branch. Okay, so exceptions to the rule. So number one, if it's in a listed country, the exemption does not apply if the PE fails the active income test and the foreign income is both adjusted tainted income and eligible designated concession income. And for a capital gain or loss in a listed company, the exemption does not apply if the capital gain or loss from the disposal of a tainted asset and capital gain is EDCI, eligible designated concession income. So basically what this is saying is, in other words, the income must relate to running an active business. If it doesn't, if it's passive income or just passive investment income, i.e. just investment in shares, not actually managing a business, it's most likely going to fail this test. And it means that the income wouldn't have an exemption in place. Now, what about in an unlisted company? So an exemption does not apply if the PE fails the active income test and the foreign income is adjusted tainted income. We'll talk about what these mean later. And then for capital gain or loss in an unlisted country, remember unlisted country are the tax evasion companies, countries. Exemption does not apply if the capital gain or loss is from a disposal of a tainted asset. Okay, so again, here's a list of listed and unlisted countries. So basically, the listed ones are specified, and if you're not specified, then you're an unlisted country. The listed ones are Canada, France, Germany, Japan, New Zealand, UK, US. Everyone else is unlisted. So the active income test is what we mentioned up above. And the purpose of the test is to identify if the investment is active as opposed to passive. Active meaning you're actually running a business. Passive meaning you're just investing in shares or whatever it is. You're not actually doing anything business related. If it is active, the income will not be taxed and the exemption will apply. If it's not, i.e. it's passive, it's assumed the taxpayer shifted income offshore and the branch's income may be taxed in Australia. So the active income test is passed if gross tainted turnover is less than 5% over gross turnover. So the definitions of what these mean is gross tainted turnover is passive income, i.e. dividends, interest, royalties, rent, capital gains, and tainted assets. And gross turnover is total revenue. So basically, in other words, your active income, i.e. the non-passive income, needs to be 95% of your gross revenue, basically. So adjusted tainted income. So for CFC purposes, tainted income, i.e. passive income and certain income from RPTs above, that is adjusted for certain terms, i.e. a foreign branch's passive income. Now another term we used above was the eligible designated concession income, EDCI. This is specified income that is taxed concessionally or untaxed by a listed country. E.g. tax-free gain on disposal of a tainted asset, for example in New Zealand, because New Zealand doesn't have CGT, but it is a listed country. So a tainted asset is an asset to the tainted income rules. It's basically anything which is passive and certain income from RPTs. So it includes financial instruments or contracts. CG exemption never applies for these. Tainted assets are the PE's assets from which the tainted income is earned. To summarize what we just talked about with the first exemption is active income, i.e. managed from a business. There's always an exemption where it's coming from a branch back to an Australian resident. So passive income, where the branch passes the active income test, exemption will always apply, but passive income where the branch fails the active income test, it depends. If it's an unlisted country, the exemption never applies. If it's a listed country and EDCI, exemption does not apply. And if it's a listed country and non-EDCI, exemption does apply. Now, capital gains losses on active assets, exemption always applies. If it's an active assets, there's always an exemption. But on tainted assets, depends if it's an unlisted country or not. If it's an unlisted country, exemption never applies because unlisted equals bad. Listed country and EDCI, exemption does not apply. Listed country and non-EDCI, exemption does apply. In fact, let's say that Section 23AH does apply and the foreign branch income is not accessible anymore. The impact of this is basically it becomes non-A income, non-accessible, non-exempt. And if you remember from all the way in Chapter 1, what we went through the difference between non-A and exempt income, neither of them you have to report in your taxable income. Neither of them allow deductions against that because you're not getting any accessible income. But the difference between exempt and non-A income is the impact on losses. So non-A income does not waste tax losses. Exempt income does waste tax losses carried forward. That's the difference. So non-A income is always preferable. Okay, so let's move on to Exemption 2, which is foreign equity distribution. So this is a distribution received by a corporate tax entity, for example, a trust or a company, from an equity interest in a new foreign company if its participation interest is greater than 10%. When an exemption applies, it's non-A income. So it's basically you need a corporate tax entity, for example, a company receiving an equity interest, for example, a dividend from a foreign company which the Australian company owns greater than 10%. Participation rule, it relates to both direct and indirect share capital, voting rights, distribution rights. As long as you got greater than 10%, it's applicable. It's only applicable to foreign equity distribution, so it's a distribution or a non-share dividend. made by a company that is a foreign resident. So the foreign entity must be a corporate, must be a company, sorry. So the exemption doesn't apply to debt interest. It must be an equity distribution, i.e. a dividend income. So it's only available to Australian resident corporate tax entities. So these are company, corporate limited partnership, corporate unit trust, public trading trust, but it doesn't apply to individuals or other trusts or partnerships. But of course, the foreign entity paying the equity distribution must be a company. A foreign company, interposed trust, or interposed partnership. Those are the only options. So the consequences of when this applies is the equity distribution becomes non-A income. So we talked about what that means. Not assessable, no deductions allowed, and losses are not wasted by non-A income. Okay, let's talk about the third one, which was a little bit confusing. So previously attributed CFC income exemption. This is Section 23AI Income Tax Act 1936. So under the CFC rules, income that is accumulated in a foreign company may be deemed to be assessable income of an Australian resident shareholder before it actually receives a distribution. So where this happens, the foreign dividend received by an Australian resident that was paid out of previously attributed CFC income is not assessable, non-exempt. And you're probably reading that sentence and going, what the hell does that mean? Because that's what I was thinking when I read it. But look at the below diagram in the notes. This will help explain it. So basically, this is the situation that they're talking about. They've got an Australian company, right, who owns a foreign subsidiary. So let's say this example, which is a company located in the United Kingdom. So in this situation, the UK Co earns $10,000. Now, because AusCo owns UK Co, the $10,000 is actually assessed in AusCo's assessable income because they are assessed on their worldwide income, including of its subsidiaries, when it does its consolidation roll-up of its profit and loss financial statements. It's going to lodge a tax return. It's going to report its global income. So it's actually going to pay tax on that 10K, even though it hasn't actually received any of the money for the 10K, because that money is sitting with UK Co. So then part 2 is UK Co actually distributes the 10K by way of a dividend to AusCo. So technically, AusCo will be taxed again because they've already paid 10K. They've already included the 10K that UK earned on its income. Now on top of that, UK Co is paying a dividend back to AusCo, and then that will be a double taxation because it's paying a dividend out of profits that's already been paid tax on. They're going to pay taxes on the profit again. There's a double taxation event right there. So hence, that's what the CFC attribution exemption is talking about, and where that occurs, that will be non-assessable, non-exempt income. Okay, now let's talk about 4, which is CTT Participation Exemption. So this is basically talking about where there's a capital gains derived by an Australian company on the disposal of its assets of its foreign company if the assets were used solely in carrying on a business and were not tainted assets. So basically, only Australian companies get the reduction. The Australian company must hold shares in a foreign company, so it's basically company to company. The shareholding must be non-portfolio, i.e. greater than 10% ownership. If it's a non-portfolio shareholding, which we said above, it must be held for 12 months in the 2 years before the CGT event. And the reduction only applies to certain CGT events, including A1, which is the most common one. The CGT event is reduced by the active foreign business asset percentage. So the active foreign business percentage is the value of active foreign business. So it's basically the percentage of assets that are active business assets. And active business assets, which we talked about before several times, is you must be carrying on a business. The assets must be related to carrying on a business. It can't be passive like ASX shares. It must be trading stock or equipment or even a vehicle if that's part of your business. Okay, moving on. So assets can elect to use either market or book value. Failure to make election makes the capital gain assessable. market value at CTT event. Book value is the average value of assets in the foreign company's accounts. Okay, now we're on to exemption 5, which is CFI exemption, Conduit Foreign Income, which is Division 802 exemption. So this is an exemption that applies to unfranked dividends that are distributed by Australian companies to non-residents. So Australian company to non-residents, unfranked. So Australian company to UK co, for example. Dividend is non-assessable, non-exempt, and not subject to tax if the dividend is declared to be CFI. So CFI is foreign income derived by Australian resident and not subject to Australian tax. So what it's saying is, actually let me show you the diagram down below, because again this is a difficult one to kind of understand. Okay, situation 1. There's some non-assessable, non-exempt income for OzCo due to the following possible situations. It could be any of them. All we know is that it's non-assessable, non-exempt income. So it could be non-portfolio interest, could be foreign branch income, could be previously attributed CFC income. If those don't quite make sense reading it, what they're referring to are the ones we talked above, these exemptions over here, which result in non-assessable, non-exempt income. For example, foreign equity distribution example that we talked about above, or the foreign branch income, which we talked about above. Any of these situations which result in non-assessable, non-exempt income. So that's where we're at. OzCo's got non-assessable, non-exempt income. Situation 2. OzCo declares a dividend paid out of non-assessable, non-exempt income, and they actually say to the ATO, this is going to be CFI. That's step 2. And then step 3 is the CFI dividend will now be non-assessable, non-exempt in the hands of foreign investor. But ordinarily, the foreign shareholder would be paying tax on that dividend. The reason is foreign shareholders are assessable on Australian income. But in this case, because it's paid out of CFI, it's non-assessable, non-exempt. And the reason is that the income's actually starting out here, like on this side of the line, basically, and then it's coming back to OzCo, and then it's going back up to foreign shareholder. So it's just kind of a conduit going through OzCo, if that makes sense. Alright, so that's all of the key exemptions. You will get quite a few exam questions going through those and identifying which is the correct exemption to use. It can be quite hard, I'm not going to lie. Just do past exam papers relating to international tax and just learn the tricks. But hopefully the explanations above kind of explained what the difference between them are. And you might have to read and rewatch it a couple of times just to understand it, because it is quite complicated. Okay, so moving on to foreign income tax offset. So we talked about before about how if you don't have one of those exemptions and you're an Australian resident and you have foreign income, some countries will withhold tax from that. And the foreign income tax offset system is basically to prevent double taxation. So for certain countries which have tax treaties, those foreign income tax can offset your tax bill in Australia, but you of course need to gross up your income in your tax return. So I will skip over this. So there's actually a FITO limit as well, and it's basically, so you can only claim FITO up to the cap of, or the greater of, $1,000 or the FITO cap amount. So generally the FITO cap amount is the higher amount. It's not usually that in a question that the cap's going to be $1,000, because the FITO limit is calculated as the income tax payable on taxable income less income tax payable on modified taxable income. So modified taxable income basically is all of the above, but it excludes assessable income on which eligible foreign income tax was paid. It excludes assessable income from foreign sources. It excludes allowable deductions. So basically you're only calculating your Australian sourced income and looking at the tax on that versus your tax payable on your total taxable income. And that's basically your FITO limit. There's a good question on that on the tax exam 219, I think it is, question 4, where you actually have to calculate that FITO limit as part of the question. So excess amounts of FITO are not refundable and they're not carried forward and it's not transferred. FITO limit increases for any amount attributed under the CFC. Income doesn't have to be sourced in a foreign country, just paid foreign tax. Okay, what about temporary residents? So designed to give special treatment to foreign employees who temporarily work in Australia. Income of temporary resident is foreign sourced, is non-assessable, non-exempt if derived when a temporary resident. Exclusion does not apply to capital gains that are taxable Australian property. Okay, next topic is taxation of foreign residents. So non-residents are taxed on Australian sourced income, i.e. when non-residents invest in Australia, income from holding, selling investment that is taxable. So you're an investor in Hong Kong, you have shares in the Australian stock market. When you sell those shares and realise capital gain, you actually have to pay tax in Australia. Now, to avoid foreigners withdrawing the money and never lodging a tax return in Australia, what Australia does in many countries around the world is they actually withhold tax on certain types of income. So, for example, dividend, interest, royalty, all have withholding amounts. So whoever it is who's paying the amount needs to withhold it if they don't have a tax file number. Management investment trust withholding is another example. Non-resident withholding for taxable Australian property is another one. Dividend withholding tax. So the biggest one is dividend, interest, and royalties. That's 30% withholding tax, which makes sense because that's roughly the average tax rates, the company tax rate in Australia historically as well. So any equity distribution is going to have that where there's no other exemption applicable. So it applies when a resident pays a dividend to a non-resident. The non-resident bears withholding tax, and the payer has tax remittance obligation, i.e., the stock exchange or the person selling the house has to actually withhold the money and lodge it to the government, pay that. The obligation's on them, not the non-resident. So the provision applies when the dividend is paid. Withholding tax will not apply if the non-resident receives a fully franked dividend. So it's non-assessable, non-exempt to the non-resident because tax has already been paid on it, so the government doesn't need to double tax it. And the withholding tax is 30%, and the franking credit is 30%, so it's basically net out, so you don't have to withhold tax on a fully franked dividend, which is basically way. Okay, so when does a dividend withholding tax apply? So if it's an Australian company to a non-resident, and it's a non-franked dividend. And when dividend withholding tax will not apply is when a non-resident receives franked dividends, or a non-resident deriving dividend via permanent establishment, or an Australian company to whoever has derived an unfranked dividend declares it to be CFI. So CFI is the exemption there. Now, dividends go with 30% withholding tax, I should have said. Interest has a 10% withholding tax. So interest is the return of a debt interest, and it's basically withholding tax will apply from a resident to a non-resident, or where a non-resident incurring interest in Australia via a permanent establishment pays to a non-resident, or a resident pays to a resident earning interest through a permanent establishment overseas, or a non-resident incurring interest through a PE paid to a resident earning interest through a permanent establishment overseas. So a few confusing situations. So what I do is I actually keep this table open as if you're going to do the question, just to make sure that the situation applies to the question and you figure out whether or not interest withholding is actually payable in this situation. But generally, any resident paying to a non-resident withholding tax of 10% is going to apply. 30% on dividends, 30% on royalties. Keep open the table when you're doing the question. So withholding tax is non-assessable, non-exempt income of the foreign resident. As the income is assessable, expenses incurred in deriving the income is not deductible. So any interest expense that a Singaporean resident has, they borrowed money to invest in shares in Australia, they can't actually claim that interest against any income they've incurred in Australia. So it's also a final tax, so it means that you don't actually need to calculate tax payable. You don't need to complete a tax return. It's meant to simplify the process. The government's saying 30% seems like a reasonable rate. We're happy to accept that for non-residents. It's not a marginal tax rate, it's a flat tax rate, 30%. Next, payer of DIR income. So non-resident bears the liability for withholding tax. POIG requires resident to withhold and remit it. If the payer does not comply, penalties, that's to the resident payer. So double tax treaties, we talked about this before. They govern in Income Tax Act 53. Aim of the double tax treaties is to avoid double taxation, prevent fiscal evasion, assist in tax collection, and to eliminate double taxation without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance. So a resident of a contracting state, only residents of a country to the treaty gain access to the benefits of the treaty. Treatment of income and gains. So tax treaties classify income and gains into baskets, classes of income. So you got business profits, dividend, interest, royalty, personal services, and they have different rulings for each. So there's some general guidelines provided, but it really depends on the exact country you're dealing with as to the double taxation agreement, because the agreement with the United States for Australia will be different to the agreement with Singapore, which will be different to the agreement with the UK, and so forth. Okay, so here are the withholding tax rates. So depending on if it's just a domestic general rule, or the ones we talked about before, so 10% interest withholding, 30% dividends if it's unfranked. If it's franked, it's 0%. If it's royalties, it's 30%. Now, if it's a country with a tax agreement treaty, they're a bit more favorable, especially for dividends. So interest is 10% still, that hasn't changed because it's already quite low. Unfranked dividend has dropped from 30% to 15%. Royalties dropped from 30% to 10%. So it definitely has more favorable withholding tax percentages. Okay, so that's the end of the international tax chapter. We've only got a few more, including international avoidance, which kind of ties into this topic, but it's actually talking about avoidance of income tax through thresholds and things like how people actually avoid it, including thin cap, transfer pricing, things like that. So we'll talk about that in the next video.